We have to understand this, that whether you're Bill Gates or Joe Schmo, right? Your taxes are marginal. They're not flat. So when you come out of the box on day one, we're all in the same tax bracket, which is 10%. So the brackets are filled progressively. So planning means managing where your income falls.
And welcome into Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional, Tim Stearns, CFP, founder of TJ Stearns Inc., Chicagoland's resource for a common sense approach to planning for your money, your finance, your investments, your retirement future, ladies and gentlemen. The plans that TJ Stearns put together are the Protect and Grow written retirement blueprint, helping you map out your plan for retirement and make sure that you are protecting and growing your money. Making wise decisions is important. And Tim, we have gotten through tax season. Whew, a sigh of relief, except
Yep.
now your tip is that this is the real time to do some effective tax planning.
Well, think about it. Now you have 9 more months of trying to get it together, right? And this is when I think the heavy lifting starts, is that make sure you learn from your mistakes if there were mistakes. And, I always talk about, being proactive when it comes to tax planning. So make sure that you're doing that and being proactive when tax planning.
Tax planning is a process, not an event. You can react or you can plan and be proactive. Everything in tax planning starts with one question, right, Tim? Where's your income coming from? Can you describe from there what the process is to understand the concept of tax planning?
Well, tax planning is literally a process. It's not just an event that happens on April 15th. And I think people don't understand that. You can react or you can actually plan. And planning actually it creates control and efficiency. And that's what we try to tell our clients. And that's why I'm glad we have a CPA on staff. One of the things we always talk about is that, making sure that you are having your CPA talk with your financial advisor. I marvel that a lot of these big box companies don't allow that or don't want that to happen. Why not have everyone on the team talking so that and it's always in your best interest to make sure that, that they understand when you're declaring Social Security, when you're, what that's going to do to your Medicare, when you're going to take your pensions, 401ks, all that good stuff.
Yeah. Tim, during our working years, the process is relatively simple. All of our income is coming from our paycheck, W-2, maybe bonus, side income. Maybe we are self-employed 1099, which does get a little bit more complicated. But retirement is really much more complicated because income sources often change dramatically. Can you talk about that process?
Well, think about this. It's not just one stream anymore, right? It's many different streams. And each source has its own tax rules. And so understanding the sources is step one. And you have many different ones. For example, your IRAs, your 401ks, you have, which is going to be taxed as ordinary income. Social Security, which up to 85% of that could be taxed. Then you, of course, have your Roth withdrawals, which will be tax free. You have capital gains, which are often taxed at lower rates. And then you can even have like things like municipal bond income. So, what I'm thinking there is that there's different income and equals different income tax treatment.
And then Tim, our bracket, our tax system is actually pretty complicated. The U.S. tax system is a progressive system, meaning that income is taxed in layers. Many people misunderstand this and think that their income, all of their income, whatever bracket they're in, it all gets taxed the same. Can you talk about helping people to understand the opportunities for managing the different tax brackets?
Well, we have to understand this, that whether you're Bill Gates or Joe Schmo, right? Your taxes are marginal. They're not flat. So when you come out of the box on day one, we're all in the same tax bracket, which is 10%. So the brackets are filled progressively. So planning means managing where your income falls. So we need to understand where that is. And by doing that, you can actually project your future income tax and your tax rates.
Right. Yeah. And I'm sorry, Tim, but planning is not about just today. It's about forecasting forward and looking into the future. So how do we tr try to attempt to manage those progressive tax brackets for not only now, but into future years?
Well, I mean, we have to point out some of the obvious that you're going to have to be taking required minimum distributions. You're going to have a loss of a spouse. Unfortunately, it's true. You'll have single filer status, which we call the widow's penalty. Um, you have increased Social Security taxation. And then, of course, unfortunately, in the last 10 years, we've seen the Medicare IRMA thresholds. So without, projection, there's tax planning and it becomes just guesswork.
And future income often increases unexpectedly, or at least the taxation of that income due to some of those factors that you mentioned, Tim.
Right. And, including the widow's penalty that can cause a tax spike. And that's, things that we talk to our clients about. That's why, you know, we need to look ahead down the road so that you're doing these things when maybe you have a couple to work with, that you're doing the Roth conversions, things that you can use these tax brackets to your advantage.
Tim, nobody likes filing taxes. Nobody likes budgeting, but these two exercises do coincide, and probably one of the most controllable elements of our financial lives.
Tax planning is closely tied to budgeting, like you said. How much income will you need? Where will it come from? And obviously, how will it be taxed? So the big thing that you want to look at is income needs drive what the tax decisions are going to be. Budgeting creates your clarity as to what the taxes will be, and the planning aligns, spending with efficiency.
And Tim, the Protect and Grow Written Retirement Income Plan is specifically designed to help savers and investors and proactive planners identify planning opportunities. Yes, from an investment standpoint, but a tax standpoint as well.
Well, yes, you're looking at you can move money from taxable IRAs to tax-free Roths. You can pay taxes now to reduce a future tax burden. And you and I have talked about this ad nauseum. Lowest tax brackets we've seen since the early 80s. So why wouldn't we want to do that? And also asset allocation, or excuse me, asset location, place inefficient assets into tax deferred accounts, place tax efficient assets into taxable accounts. And obviously you're looking at capital gains planning, using lower capital gain rates, to your advantage. And obviously looking at income timing. So.
So planning creates those opportunities. And I know that, Tim, you help to put each asset in the right column or in the right bucket or category so that the overall flow of growth and income is more tax efficient.
Right. And we want favorable long-term capital gain rates. You can do tax loss harvesting opportunities. You have that step-up basis at death, which a lot of people, believe it or not, don't even know about. And then there's no RMD requirements then as well.
In those non-qualified accounts. Tim, I know that TikTok is not the ultimate source for financial guidance, but I have seen a lot of information and material on social media talking about the advantage of non-retirement, non-qualified assets as part of the overall financial picture. And I think people are starting to realize that, although that point you mentioned that not everybody realizes all of the advantages, like the stepped up cost basis, I think that is an often overlooked element with the way that we're taught to save all our money in our 401ks.
Right. And I've had so many people say, "Oh, when we sell my dad's house, we'll have to pay the taxes." And no, 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 wait a second. And I explained to them, no, you get a step up basis. Same with his stocks. Same with this, in a non-qualified account, of course.
Right.
So there's a lot of different things that are out there, but without a plan, let's get back to taxes. Sometimes taxes become a process of guessing, reacting, adjusting after the fact, and who wants that? So let's look at this can lead to, things like higher lifetime taxes, missed opportunities, and then terribly unexpected surprises that you really don't want.
Yeah,
So
when you say plan, Tim, I feel strategic, and
yeah,
without a plan, I feel like it's trial and error and learn through mistakes and experience.
right. And that can be very expensive. And planning creates, predictability, and strategy replaces the guesswork out of that.
Well, Tim, one of the most important factors in this conversation, I think, is that the rules can change. We are under the constant potential threat of legislative risk when it comes to taxes, our tax code, and the way that our income and accounts are taxed.
Right. And as we know, tax laws are not permanent. So we should take advantage of what's going on right now because tax brackets can change, deductions can be eliminated, retirement rules can shift, and obviously new policies can be introduced. So that's why planning often includes taking advantage of opportunities while they exist, which is right now.
Tim, just a few years ago, I remember a lot of discussion about the Secure Act, which
Yeah.
seemed like a good thing at face value, moving that RMD age back from 70 and a half to 72.
Yep.
However, the small print, the fine print that nobody really focused on previous to that, we had generations of tax deferral advantage available to us.
Right.
Tax deferred advantage available to us. And they eliminated that. Now, beneficiaries do not have the ability to continue deferring our IRAs throughout and over their lifetime.
Or even a Roth. You have to drain it within 10 years, which has obviously changed the landscape of, the amount of money that you could leave to your family over generations was taken away.
Yeah.
So make sure that what's the takeaway here? Make sure you understand it. You project, you coordinate, and you make your adjustments. The goal isn't to eliminate taxes, but it's to manage them efficiently over time.
Well, Tim, as you have talked about on this program before, taxes are one of our largest known expenses that we'll face over our lifetime. You've got that great report that you've offered, the three biggest expenses in retirement and how to plan to control them. Taxes, number one on that list, but with the right process and an understanding of our income and how the brackets and the progressive tax system work, we can move from reacting to planning for taxes effectively, meaning we keep more of our money and save on the tax payments we will have.
Which is obviously what it's all about. Who wants to pay more than their fair share? And nowadays, that's about the only thing we can get anyone to agree upon.
Manageable with planning, often with much less risk than shooting for higher returns, ladies and gentlemen. So get your Protect and Grow written retirement blueprint put together. Pick up the phone, give Tim Stearns, CFP, TJ Stearns Inc. a call, 800-640-2256. That is 800-640-2256. Specifically, if you'd like to learn how to generate more income and pay less in taxes, you need to get that Protect and Grow written retirement blueprint in your hands. 800-640-2256. That is 800-640-2256. Tim, thank you for the reminder. Yes, tax filing season wrapping up, but now it's tax planning season.
Thanks, Peter, for having me.
Tune into Chicagoland's certified financial planner Tim Stearns' full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Investment advisory services offered through Cornerstone Securities, LLC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.